Unit 2, Product Information, Investment Company Securities, and Variable Contracts. Investment Company Offerings. The Investment Company Act of 1940. The Investment Company Act of 1940 defines and regulates investment companies. Investment companies existed prior to this act, but this is the act that defines them and regulates them. Investment companies have three classifications: face amount certificates, management investment companies, and unit investment trusts. There are two types of unit investment trusts, fixed and non-fixed, and there are two types of management investment companies, closed-end, which are mutual funds, and open-end, which are mutual funds, and closed-end, which behave like corporations. So let's talk about these a little bit more. The first one is a face amount certificate. The face amount certificate is purchased at a discount and matures at its face amount. Sounds a lot like a zero coupon. As an investor, you could go out and buy a zero coupon, but all of your money would be tied to one issuer. And if they went belly up, you'd lose everything. With a face amount certificate, you're pooling your money with other investors, and you're going to have a professional go out and purchase what amounts to be a portfolio of zeros. And if one of those defaults, it'll sting you, but you won't lose everything. The face amount certificate is not managed. So once that portfolio is put together, we're just going to let it ride until it matures. The unit investment trusts, most unit investment trusts are fixed, and it could be a portfolio of bonds or a portfolio of equities, but the vast majority of unit investment trusts are portfolios of bonds. So that's the example that I'm going to use. As an investor, you could go out and buy a bond, all of your money tied to that one issuer, and if they go belly up, you're going to lose everything. But with this unit investment trust, you're going to pool your money with lots of other investors, and you're going to have a professional go out and purchase a portfolio of bonds. If one of those bonds defaults, it'll sting you, but you won't lose everything. The unit investment trust is non-managed. So once that portfolio is put together, we let it ride until it matures. Face amount certificates and unit investment trusts are redeemable securities. And that means there's no secondary market. If you'd like to redeem your interest in a face amount certificate or a unit investment trust, you do it through the face amount certificate company or the unit investment trust company. The non-fixed unit investment trust, that would be a contractual plan, and we're going to talk about contractual plans in another video presentation. Most of the questions that you get on investment company offerings will involve the managed companies, the open-end and closed-end companies. It may be helpful for you if you can just think of open-end companies as mutual funds, because that's what they are. They're mutual funds. And if you can think of the closed-end company as an entity that behaves like a corporation, that'll go a long way toward your understanding. This is a great little chart that compares the closed-end company shares with open-end company shares. So remember that the closed-end company behaves like a corporation. Now you're still pooling your money with lots of other investors, and you're going to have a professional manage that money to a clearly defined investment objective, but it behaves like a corporation. So when corporations issue securities, they issue a fixed number of securities, and so do closed-end companies. Corporations may issue common stock, preferred stock, debt securities, so do closed-end companies. Corporations issue full shares, not fractional shares, so do closed-end companies. The initial offering will be done with a prospectus, and then the securities will trade on exchanges or over the counter. So no difference here between how a corporate security behaves and how a closed-end company security behaves. Corporate securities trading in the secondary market have a price that's determined by supply and demand. The same with our closed-end company. Shareholder rights include dividends when declared and other voting rights. And the ex-dividend date is set by the self-regulatory organization, just like corporations. So I'm really not seeing any differences between how this closed-end company behaves and how a corporation behaves. So when you get your questions on closed-end company shares, you need to be thinking, how does a corporation behave? Because that's where the answer to your question is. How does a corporation behave? Mutual funds are different. Mutual funds issue an unlimited, continuous primary offering of shares. Every share is a brand new share. They only issue one class of security, and that's common stock. A mutual fund can purchase common stock, it can purchase preferred stock, it can purchase debt for its portfolio, but it only issues common stock. If you're an investor in the ABC Bond Fund, you receive common stock of the ABC Bond Fund. Mutual funds only issue one class of security, common stock. And for anybody that's ever purchased a mutual fund, you know that they issue not only full shares, but fractional shares. Initially, they will be sold with a prospectus, and since there's no secondary market, every time you sell a mutual fund, it's sold with a prospectus. Price is determined by a formula, which we'll talk about shortly. Shareholder rights include those dividends when declared and other voting privileges. And there is a difference here between corporations and mutual funds when it comes to the ex-dividend date. Remember, with corporate securities, we know that the ex-dividend date is set by the self-regulatory organization, FINRA, or the exchange where the security trades. But with mutual funds, the board of directors sets all of the dates. Every date, the declaration date, the record date, the ex-date, and the payable date. And I stated that in a little different order than I did before. With corporate securities, we said it was D, E, R, P, DERP for corporate securities, and the spread between the ex-date and the record date was always 2 business days. Well, it's different for the mutual funds. It's not DERP, it's DREP. Because instead of regular way settlement for mutual funds, the assumption is always cash settlement. You would never assume cash settlement for a corporate security, but you do assume it for mutual funds. Now, if we're using cash settlement, and this is the record date, when's the last day you can trade for a mutual fund and get the dividend? On the record date, you could. So if that's true, what's the first day that you could trade for a mutual fund and not get the dividend? It would be the very next day. The ex-dividend date is one business day after the record date. So the spread between these 2 days when it comes to mutual funds is one business day. And remember, it's DREP for mutual funds and DERP for corporate securities. One of the big attractions of open and closed-end company shares is that they tend to be diversified. These portfolios, they get quite large. Hundreds of millions, billions, tens of billions of dollars. And with that kind of money, you can get pretty diversified. People like that. But in order to market yourself to the public as being diversified, you need to meet certain guidelines. And those guidelines are the 75-5-10 rule. So 75% of your assets are invested in securities of other than the investment company securities or affiliates of the investment company. In other words, I just can't take all your money and invest it in myself and affiliates of myself and then call myself diversified. 75% of my assets need to be invested in securities of other than the investment company securities or affiliates of the investment company. No more than 5% of the fund's assets are invested in any one issuer. And the fund owns no more than 10% of the voting stock of any one issuer. The idea is not to control companies. If you've got $30 billion to invest, you could just buy companies. But we don't want you buying companies and then calling yourself diversified. So you have to meet these guidelines, the 75-5-10 rule. Notice that there are no restrictions on the remaining 25%. Don't think about that too deeply. It'll confuse you. But just remember, no restrictions on the remaining 25% of assets. What's the definition of non-diversified? You're not diversified. I love that definition. So a couple of special securities that we see at the bottom of this page: exchange-traded funds, ETFs, which are mutual funds usually based on an index that trade on exchanges. They trade like stocks. Series 6 registered reps cannot be involved. They can't get engaged in ETFs. It's not a security that you can participate in, at least buying or selling them for clients. And the same thing is true of the hedge fund, which is really it's changing, but there's not a whole lot of regulation for hedge funds. And that's because they're sold to very sophisticated investors. They're not available to most of us. And that's really what I would want you to know about these special securities at the bottom of the page, is that as a Series 6 registered rep, you can't sell ETFs or buy or trade them for customers.